Welcome to everyone who just joined. As we're starting to get settled in, just threw a quick poll question in the chat. Welcome responses from folks with any fun guesses. Chelsea and Jerel as our experts, intrigued to hear your guesses as well.
All right, so we have what percentage of Americans are real estate investors? Jerel, what are we thinking?
I'm going with 60%.
I'm seeing 60, I'm seeing 35, I'm seeing 75. Okay.
I should clarify, non-primary residence investors.
Non-primary residence investors. Okay.
Yeah, so this is not about buying your primary home.
Now the number is getting lower. We're at
Oh, I swayed the
20,
poll too much.
Guys, don't let part thieves get you out of your answers, okay? Stick with it, guys.
All right, let's see if we can get a few more. We got another 20. Chris, you were at 75, now we're at 20. Awesome. Well, Parthiv, are you planning to share the answer?
Drum roll. So I think we saw one guess that was the closest. Susanna at 35. So the answer is 34%. According to Gallup, 34%. So well done.
Nicely done, Susanna. Perfect. Well, Jerel, I think we're ready to get started now. So thank you everyone for joining our webinar today around the 3 financial advantages to real estate investing. Really, as part of our conversation, we want to make sure this is a collaborative experience. So feel free to hop in the chat, come off mute if you want to address any questions or share any experiences that you've had with real estate investing as well. You may be wondering who we are, so I'll kick us off, and then Jerel, I'll kick it to you so we can introduce ourselves. My name is Chelsea Ransom-Cooper. I am a certified financial planner and the Chief Financial Planning Officer here at Zenith Wealth Partners. At Zenith, we pride ourselves on being a fee-only financial planning and investment advisory firm to help women, people of color, and the institutions that serve them on their financial journey. My own experience with real estate has been through the transition when my grandmother passed away and then transitioned her home into my family and then utilizing that as a stream of passive income. But on top of that, helping our clients understand how real estate can fit into their overall financial plan as an opportunity to grow their wealth, plan for retirement, and then get some additional income as well. Jerel, I'll kick it over to you.
Thank you, Chelsea. My name is Jerel Butler. I am also a certified financial planner here at Zenith Wealth Partners. I'm originally from New Orleans, Louisiana, and I've had the pleasure to live in various different cities where I really became intrigued with the concept of real estate. Outside of Zenith, I am a avid real estate investor. My wife and I own several real estate investments. Actually, our home is actually considered a real estate investment because it's a multi-family property. So we'll go into some of the ins and outs of the different types of real estate holdings that you can have in your investment portfolio. I'm also a expert in business planning. So as it pertains to real estate investment as a business, we'll also dive into how real estate can enhance your portfolio in multiple ways. So with that being said, let's go ahead and get started. All right, so looking at the table of contents, guys, this is going to be a really informative webinar. First, we're going to get into what are the different types of real estate investments. There are 5 major types of real estate investments. So we'll walk through each of those, what they mean, and what you can do to add them to your portfolio. From there, we'll talk about the financial benefits of real estate. I know a lot of times we talk about passive income, but there are multiple ways in which your portfolio and your real estate investments can be a suitable addition to your financial planning repertoire. We'll also talk about a key bonus benefit that isn't really discussed a whole lot in real estate as it pertains to returns, but it's just as valuable as you're evaluating potential real estate deals. And then we'll do a wrap up of the key takeaways and open up the floor for some questions. If you guys do have questions throughout the presentation, just please raise your hand or drop a comment in the chat box, and we'll make sure to answer along the way, because we do want this presentation to be not only informative, but collaborative as well. All right, so looking at the different types of real estate, the most common one that a lot of people are familiar with is single family homes, right? People think of the 40 acres and the mule dream, and you think, hey, okay, single family homes is what I know about real estate, right? And it's pretty simple, right? It's a home that is meant to house one family. Typically, most people use single family homes as a primary home, but it can also be used as a investment property. So we'll get into that as well. Next is vacation rentals, right? So as you think about vacation rentals, they're getting more and more popular as time goes on. I'm sure most of us have used some of these platforms such as Airbnb, VRBO, and essentially vacation rentals have turned into a very reasonable alternative to acquiring a hotel for your vacation stay. So this also can be a viable investment property as well. Now we're getting into some of the more multifamily type of investments. So multifamily properties, it provides a family to potentially live in one unit of the property while renting out the other units. Typically, a multifamily property can be considered a duplex, which is 2 family units, a triplex, which is 3 family units, or a quadruplex, which is 4 family units. After 4, you start getting into what's called cooperations or apartments, right? Condominiums. That's the next level of multifamily properties, right? So condos are typically made up of, one or several buildings that can house several families within that building. Typically, they will share common responsibilities, such as maintenance for the buildings, etc. And then there's commercial real estate. So commercial real estate is real estate that is used for the purpose of business and um, commerce. So things such as offices, retail spaces, warehouse, restaurants, all of those are considered commercial real estate investments. And they all still have the ability to appreciate over time. So even though you may be familiar with only one type of real estate, within these 5 different areas of real estate, you can participate from the investment side.
And Jerel, is there one type of real estate where you tend to see as the most common place that people like to get started on their real estate investing journey?
Yeah, absolutely. Typically, the most common areas for real estate investment tend to be single family homes and multifamily properties. And those are essentially the easiest forms of real estate to get involved in. Typically, with your first property that you buy, you have the ability to actually get a multifamily property without having to put a lot of money down. So we'll talk a little bit more about financing, how you can acquire some of these investment properties throughout the call as well. All right, so different types of real estate investments, right? So we'll go through these 6 types of real estate investments, and we'll open it up the floor to any questions that you guys do have. We would love to learn in the chat if any of you guys are involved in investment real estate and what type of real estate investment. Starting off, let's talk about real estate investment trust, right? So this is a form of real estate that is considered passive, right? Meaning that you won't directly have control over the real estate investment, but essentially you are investing in a what we would like to essentially call a real estate mutual fund that invests in different real estate assets that you can then take passive income throughout the year on, right? So this is a really easy way to get into real estate without having the hassle of maintenance on the property, filling out paperwork. Essentially, this is considered a passive investment where you can earn a reasonable return over time. Another key type of real estate investment that is very, very popular in today's age is short-term rentals. And short-term rentals are popular for several reasons. One, short-term rentals allow the ability to not be locked into a long-term renter, which allows you to adjust your rental rates accordingly. It's become a really popular way for people who are on vacation to have more space than they typically would in a hotel environment, and have the amenities of being in a home. Short-term rentals tend to be more profitable than your traditional long-term rentals. So short-term rentals in certain cities have restrictions. But if you're in a city that does not have any short-term rental restrictions, this can be a really lucrative investment option for your portfolio.
Yeah. And something else I would also add is I think short-term rentals can feel like it's passive, but it's actually a pretty active strategy too. Depending on how frequently you're having individuals in there and understanding the peaks and valleys of when there's really highs in the market, whether it's summer if you're near the beach, or weekends are really like your prime market. It's really important to understand when you're going to have those vacancies so you can figure out what is the best price point for your short-term rental so that you could smooth out the cash flow that you're receiving.
Yeah, Chelsea, that's a great point. And when you compare it to long-term rentals, right? Those are some of the distinct differences, right? When you're in a long-term rental, typically it does feel less active of an investment than short-term rentals, right? You have one or two tenants in there at one time. Um, you can, anticipate some of the maintenance costs a little better. And the regulation around those income earning uh, properties tend to be less, right? But on the other hand, like you said, I think the earning potential for short-term rentals is higher, which does require a little bit more of active management. So, and this actually affects how you file your real estate investment as well. Short-term rentals are filed in a different place on the Schedule C than long-term rentals. Long-term rentals tend to be filed on Schedule E because of their passive nature. So we'll get a little bit more into those benefits and some of those breakdowns later in the call.
Yeah, absolutely. And one other thing I'll add, because I know we're definitely beating a dead horse on this one, but understanding that we are in a higher interest rate environment than we were in past years. So when we're looking at the different types of rentals, you want to make sure you're getting a positive return on the investment as well. Long-term rentals did incredibly well when interest rates were lower, but now it's really hard to find that positive return, which is why a lot of individuals are looking towards that more active approach with short-term rentals to make sure they're getting that positive cash return.
Absolutely, absolutely. So, looking at the other types of real estate investments, and I'll try to be a little quicker here. House flipping. So some of you may be familiar with that term, and essentially, that is the process of acquiring a property, making renovations, which is also called rehab or rehabilitation, fixing the property up, and then selling it for a profit. So that has been a really popular strategy, especially in a market that may be considered a seller's market. Typically, when there is a lot of demand, maybe even more than supply, the house flipping strategy can tend to be really fruitful from a revenue perspective. But on the flip side, if we're in an environment where it would be considered a buyer's market, right? Meaning that there is more supply than there is demand. Sometimes house flipping can be a bit of a riskier investment. Also, real estate syndicates. This is essentially entails of an investor who wants to invest in a specific real estate project or development. Typically, that project or development will be considered a new construction project, sometimes a rehabilitation, but essentially, you have the ability to invest equity into a real estate project for a new construction or rehabilitation. And once that property is completed, it is then either refinanced or sold, and then the profits are given back to the investors. So real estate syndicates sometimes tend to be higher on the risk tolerance scale than some of your other real estate investments, but they tend to yield some of the biggest returns, right? So if you're looking to add a bit of diversity to your portfolio in terms of the opportunity to supersize your returns, real estate syndicates can be a great option. And then finally, house hacking, multi-unit properties, right? So I alluded earlier to the fact that my first property that myself and my wife bought was actually a multi-unit property where we live in one side and then we're able to rent out the other side. And depending on the financials behind this particular investment, you actually can end up maybe staying in your home for free, right? Having the rental income pay the mortgage on the property. And then a lot of times you're able to write off the mortgage interest, insurance costs, as well as related utility expenses related to your rental property. So when you look at all of the different tax benefits, the cash on cash benefits, house hacking is a great way to get started into real estate investing.
And with all of these, there's going to be pros and cons, and there's going to be ones that really just make more sense for your plan or less. But I think the key things to focus on are, what type of investor do you want to be? Do you want to be active? Do you want to be more passive? And then understanding what is the return and how this fits into your overall financial plan.
All right, so we have a question before we go to the next slide. So can I combine these different strategies at the same time? Absolutely. And a lot of times you will see a lot of collaboration between these different types of real estate investments, right? So for example, short-term rentals can act as a form of house hacking, right? So you can have a multi-unit property, you can live in one side, and then you can choose to short-term rental the other unit, right? You don't have to necessarily make it a long-term rental. You can make it a short-term rental. In the example of real estate investment trust.
Thank you.
No problem. Real estate investment trusts tend to invest in real estate syndicates a lot of times, right? So a lot of your new construction projects, they
You have
actually
change?
funded by a REIT. So yes, oftentimes you will see a combination of these different strategies as they relate to your portfolio.
And Jerel, we did get another question. Are there any cons to any of these strategies that you could call out relatively quickly?
Sure. So I think, something to definitely consider with real estate investments is the level of risk that you are able to take on, right? If you are a risk averse person, meaning that, you really want to stay on the side of safe investments, um, investments such as things like real estate syndicates or, short-term rentals, which may require, more, active management. Those type of investments may not be a good fit for you because of the uncertainty in those returns, right? Also understanding regulation. We have a lot of major cities in the USA, cracking down on Airbnb and VRBO short-term rental regulations. Even here in New Orleans, which is where I currently am, New Orleans has a very, very strict short-term rental law, right? Essentially, you have to win a lottery to be able to get a short-term rental license. Whereas you have some other cities, such as I believe Houston. I don't believe Houston has any, short-term rental regulations, right? So you can literally rent a house and then turn around and make it a short-term rental. So I think, regulation risk is definitely something to consider as you're looking at these different types of investments, as well as return on investment. And a lot of the returns on investments for these different projects have several macroeconomic factors that you have to consider. What's the current interest rate environment? What's the supply to demand ratio in the, certain neighborhoods? What is the political climate? So there are a lot of different factors that can go into what type of real estate investment is just right for you.
Awesome. And if there's any other questions, feel free to drop them in the chat and we can address them as well. So we touched on the different types of real estate. We talked about the different types of real estate investments. Now let's get to the main reason why a lot of us are here. Let's highlight some of the benefits when it comes to real estate investing in general. Overall, when we talk to individuals and especially a lot of our clients, real estate is the most important thing as part of their financial plan. They want to make sure that they have an opportunity to get access to real estate because it's tangible. They can see it, they can hold it. And even though they understand stocks and bonds and investing for retirement is incredibly important, there's still some power in understanding and owning a piece of real estate. The benefits of owning real estate is there is roughly steady appreciation. So when we look at real estate trends, it tends to appreciate anywhere from, let's say, 2 to 4% on an annual basis. Now, we also can acknowledge that in the past, it might have appreciated even faster than that, maybe 5 to 7% in different areas. But when we look at the consistency of that long-term growth trend, that's really what we're seeing closer to that in the middle of that 3%. As property values do continue to increase, as there's changes within your neighborhood and your community, there's an opportunity for that equity to continue to grow. And that equity is truly an asset because it gives you the flexibility, whether it's when you decide to sell the home or you want to take out a HELOC or whatever the case may be, you'll have access to that equity and that nest egg as you're planning for your future. The returns can feel stable. Now, we always want to say real estate is not necessarily a linear return, although it can feel like it, just because we don't see the ups and downs and the volatility like we see in the public stock market. But there is still an opportunity to get some relatively predictable returns as you're planning for real estate in your portfolio.
So yeah, guys, looking at benefit too, there are several ways to generate consistent passive income. First is looking at the income stream and how reliable it is, right? Rental properties on a normal basis can provide a steady monthly income, right? And this is true for short-term rentals and long-term rentals, as well as commercial real estate, right? Typically, you want to be able to invest in an income stream that has low vacancies, right? Which leads to things like steady cash flow, and making sure that the maintenance costs are controllable, right? So having those different reliable income streams is a huge plus with real estate. Also, if you're looking to supplement earnings, real estate can be a really great tool for that as well. Real estate does not have to be a priority income for you, right? You can use it to facilitate additional savings, and really understanding, how this can fit into things such as a retirement fund, right? You can take the earnings from a real estate investment. You can invest it in things like your Roth IRA or traditional IRA accounts. You can invest it into taxable accounts, which gives it the opportunity to earn additional income and interest. So there are ways that you can use real estate to supplement your earnings as well. And as I mentioned, steady cash flow. Um, Typically, even though you may have some vacancies at any given point in time within your real estate portfolio, over time, as we look at the cash on cash, flow of your real estate investment, typically things such as tax benefits, depreciation, which we'll go into next as well, all of those things can increase your overall return on the property.
Now, Jerel, when we're working with a lot of our clients and they're planning to include real estate as part of their financial plan, they want to see how real estate can help them reach that work optional lifestyle, right? So after they cover their expenses, how can they really come up with a strategy to identify, how much income a property is generating? And then like, what is a good percentage or dollar amount that they should be able to generate where honestly, like the property even makes sense from an income standpoint?
You know what? That's a great question. And I'm going to answer it in two ways, right? I think the first answer is you would ideally want to get somewhere between 8 to 10% annually on your real estate investment, right? Meaning that for the amount that you've paid for the property, if you can receive somewhere between 8 to 10% of that amount annually, I think that does a couple of things, right? Number one, that outpaces the pace of inflation. And then also it allows you to actually feel a somewhat of a reliable income stream, right? Now, I think it's going to vary depending on where you are, right? Location definitely matters when it comes to real estate, right? So, for example, when you're evaluating a real estate project, there are several different factors that can affect the profitability, right? Things such as insurance, um, interest rates, right? Especially in states like Louisiana and Florida. Right now, the insurance market is through the roof, which makes real estate investing really, really hard if the numbers don't tie, right? Insurance costs, property taxes, uh, the interest rate for the mortgage if you're taking out one. Currently we are in what we consider a high interest rate environment that has actually curbed some of the real estate investment potential. Now we're hopeful that with the next Federal Reserve call that those interest rates do get slashed some, and we think that may spur some more investment. But all of these factors need to go into your calculation on whether a real estate investment makes sense. And to be transparent, sometimes it doesn't, right? Sometimes you won't get that 8% desired return that you want. It may say, hey, you may generate a 4 or 5% annual return, and that may not be worth the hassle for that particular project, and you may need to continue to like shop around for the best deal.
Yeah, and I think that's super spot on, right? Because if you're not going to get that 8 to 10, and maybe it is 4 or 5, you also have to look at, is that property appreciating? Is it in a space where you can continuously get value there? And if not, that's the tough conversation of, okay, maybe this property doesn't make sense and I need to keep exploring. But I think you touched on great points about principal, interest, taxes, and insurance. And all of those pieces impact what that cash on cash return looks like. We actually have a spreadsheet here at Zenith that we help clients with. So if you want to take a look at the spreadsheet, feel free to let us know in the chat and we'll make sure that we can send it over to you too. But Jerel, we do have one more question. So how do clients manage all of these properties? Is it handled by one point person or does the client usually manage it on their own?
Great question. So it varies, right? You have some landlords, for lack of a better word, who tend to be very active and very hands-on. They will handle the maintenance requests. They will handle all of the aspects of managing that property. And then you have uh, some investors that choose to hire a management company to do all of the work related to managing properties. So especially if you have multiple properties, you most likely will have some type of management company that handles the day-to-day operations for you, right? And that becomes really, really valuable, especially as you expand your portfolio. But to our point, those are some costs that you have to build in to your analysis to make sure that investing in a particular real estate deal makes sense. Management fees are something that you need to take into account. Great question.
So now it's principal, interest, taxes, insurance, and management fees. I know there's some more, but I won't jump ahead too far. So the next benefit we want to touch on is portfolio diversification. This is incredibly important because we don't want to make sure we're fully or overly concentrated in one asset class. So what does it really mean? Well, by diversifying your overall portfolio, we're helping to minimize risk while still getting competitive returns. And when we talk about diversification, we want to make sure we have different pieces that don't maneuver in the same fashion, right? So if their interest rates decide to go down, and then one asset class may have a really positive experience, and one may necessarily not have a middle experience, or maybe a less positive experience, but it helps you balance it out versus if you had everything maneuvering in the same fashion. When things go down, then everything will be down. It's something important that we think about as we're constructing portfolios for our clients when we're looking at stocks, bonds, and ETFs that make the most sense for their financial plan. But we don't stop there. We also make sure we're looking at real estate as well to see how this is included. When we think about how much you want to have in one particular stock or fund, we typically like to say 5 to 10% so that you're not overly concentrated. But with real estate, and if it's a non-primary asset, you can fluctuate a little bit higher. Sometimes we're seeing individuals closer to 25 or even 30 or even 40%, especially if they're really passionate and they're really active investors. So it's important to understand what that diversification strategy is, what your risk tolerance is, what your liquidity needs are, and then overall, what are the tax benefits of each of these asset classes. And actually, oh, I was just going to say, we do have one other question coming in. So what steps do you recommend someone to take as they are trying to determine which type of real estate investment opportunities are best for them?
All right. This is where your trustee certified financial planner comes in, right? Um, Typically, a finance professional can definitely help you sort through the different options as it pertains to investing in real estate. It's especially understanding what's your potential return on investment, right? So the first thing that I would say is, make a list of any potential real estate investment opportunities that do pique your interest. From there, start to gather information such as investment cost, um, location, type of real estate investment, and then I think from there you can reach out to myself, Chelsea, or any one of us on the team, and we can actually do an analysis for you based on that information and give you some insight on what would make that an acceptable investment.
And we got one more, Jerel. So when seeking out property locations to invest in, from an investment perspective, is it worth it to research the future building plans of the area? I
Ooh,
like
that's
this
a
one,
great one.
right?
Ooh,
This is a
okay,
good
all right.
one.
That's an urban planning question. Okay, great. No, absolutely. Great question. And this leads to another aspect that is truly important when you're considering real estate investments, and that is zoning. All right. Now you may have heard the word before in certain circles, maybe in your city council meeting, but zoning is extremely important to the profitability of a real estate investment. And basically what zoning means is Zoning consists of the rules and regulations that your local jurisdiction has put in place for a certain tract of land, right? So for example, one zoning classification could be considered C1, right? And C1 means commercial real estate. It may be an area that is built for walking traffic, right? That zoning is completely different than a zoning that would be single family homes, right? So in a zoning that's single family homes, you can only put that type of property on that particular lot. Right now, it's good to understand, what zoning regulations exist in your locality. You may be in an area that has a highly regulated zoning authority, and then you may be in a city that has no zoning. Right. I'm going to go back to Houston. Houston, I want to say has little to no zoning. Like you can put a grocery store next to a three-story home, right? Like it's they have I don't think they have much uniformity in their zoning code. But then in New Orleans, we have a historical district, right? So you can't put anything in that historical district that doesn't meet the zoning requirements, right? So yes, definitely understanding what are the future building plans and what's the current zoning structure, and if that zoning structure is going to change in the future. All of that is definitely vital to making a sound investment.
I think those are great examples. And I would also add up here in the Northeast. So I live in Jersey City, New Jersey, near Newark and the Prudential Center. And they've been doing a ton of development over there, looking at opportunities to build more spaces around the arena. So there's a lot of opportunity for new properties, new developments, or even some older properties that have kind of been sitting there to get rehabilitated and then rented out in the future as well. So understanding what your market is, what are the opportunities, what are the growth spaces, maybe just in your own neighborhood.
Absolutely, absolutely. So our last benefit, but definitely not least, is tax savings, right? And honestly, there needs to be more discussions around the wonderful benefits that investing in real estate can do from a tax perspective, right? So let's get into them. Number one is depreciation, right? And what depreciation essentially means is that it allows you to deduct a portion of your property's value annually, right? So essentially, for example, let's say your investment home, let's say you have a multi-family home, it's a duplex, it's 2 units, it's worth $500,000, right? The IRS allows you to depreciate an investment property over a 27-year lifespan, right? So essentially you would take that $500,000 divided by 27 and a half. And then that amount you can actually deduct on your taxes. Even though you didn't have a true cash expense, that can result in a $25,000 reduction in your taxable income. And, it's a paper deduction, right? It's not a real cash deduction that you took. It's something that you can do within the tax law. That alone may result in a $7,000 to $8,000 tax savings, depending on what bracket that you're in. So deduction is one of the single biggest. I'm sorry, depreciation is one of the single biggest things that you can do from a tax savings perspective on a real estate investment property. And it's important to note that you can only depreciate investment properties. You can't depreciate your primary home, right? A lot of times, you may hear things such as purchasing a primary home has great tax benefits. Well, it used to, but since the new tax code, there isn't really much of a tax benefit with buying a primary home, right? A lot of those benefits are only currently reserved for investment properties. So as you're thinking about, even if, you haven't purchased a property yet, maybe your first property should be a multi-family property, because then you'll at least be able to take advantage of depreciation. All right. So remember that word. It's a glorious tax benefit that we don't talk about enough. All right. Second, maintenance write-offs. Right. Maintenance expenses are generally fully deductible in the year that they are incurred. Right. So if you do have maintenance, such as landscaping, paying utilities, cutting the grass, fixing plumbing, all of those things are expenses related to managing the property, right? So all of those are deductible on your taxes. Property taxes, right? Now let me go a little bit deeper into property taxes, right? If you have a primary home, you can possibly deduct the property taxes and the mortgage interest if you reach a certain itemized deduction threshold, right? It's not guaranteed. And what we've been seeing with this new tax code that rolled out about 4 or 5 years ago with the Tax Cuts and Jobs Act is that most married couples can't meet that threshold, right? So you may have a primary home, but if your standard deduction is $29,000, that means you would have to have $29,000 worth of property taxes and insurance to even get that benefit, right? But if you have an investment property, you can deduct the property taxes, the insurance, and the mortgage interest related to that property without having to um, have it meet that itemized, or I'm sorry, that standard deduction threshold, right? So you can still take the standard deduction on your taxes and claim the property tax, interest, and insurance tax deduction as well, right? And then finally, write-offs, right? So again, related to the property taxes, mortgage interest deduction, you are guaranteed to be able to write it off for an investment property. On a primary home, it is a good chance that you will only be able to deduct partial, sometimes none of it, right? So these are some of the distinct advantages from a tax perspective where you definitely want to prioritize having investment, having real estate investment options within your overall portfolio.
So
All right,
Jerel, we do have another question coming in. So what if you have a primary and you eventually turn your primary into an investment property? Will you still get the tax benefit of depreciation?
all right, great question. So if you have a primary home, you turn it into an investment property. Now that investment property is eligible for depreciation, right? It's not eligible before as a primary, right? So if you choose to move out that home and you decide to rent it out, now you can depreciate the value on your taxes, and you can um, deduct the mortgage interest, insurance, and property taxes on the Schedule E if it's a long-term rental, or the Schedule C if it's a short-term rental. And I know I'm throwing out these letters right now, guys, but essentially, you will use the Schedule C for short-term rentals because, as we said, that is a more active management investment. So you're able to actually have unlimited losses. So that's another huge advantage on the Schedule C, is that your losses aren't limited. On the Schedule E, where you would typically report long-term rentals, where you're more in a passive investment state, there are limits to how much losses you can claim on your taxes in 1 year. So that's another key distinction as well.
Great point. And you actually covered one of the questions, which was how do you report, short-term rental income on your taxes, but it's through that Schedule C that you were touching on. Another question we have is, do these tax benefits change if the property is set up as an LLC, specifically the tax benefits you just touched on in this slide? Or are there additional benefits that you can consider if you put your property in an LLC?
So from a tax perspective, putting it in the LLC, honestly, from a tax perspective, it won't matter much. Because I mean, if you're operating as an active real estate business, you don't need the LLC to put it on the Schedule C, right? Typically, that won't have a impact on your taxes. Now, from a standpoint of liability, that is a good option to potentially put your properties in the LLC. If you want to take it a step further, you can then put that particular real estate LLC into a revocable trust. That is something that we can also give advice on here at Zenith. We have a wonderful estate planning expert in Famine, who can give you all of the different strategies in regards to estate planning, especially when it comes to real estate. But from a tax benefit perspective, to be honest, not really. You would, unless you operated, no, to be honest, I mean, it's not that much different than reporting on your own Schedule C.
Awesome. These are great questions. Let's tag in. Let me just double check and make sure I'm not missing any others. Perfect. I think we covered a lot. And we also did plug, of course, Famine, who is amazing with trust and estates, but also have to call out Alan Elder, who is also on the call, who does tax filing and bookkeeping and can assist with this work as well.
Awesome. So, as we look at the key takeaways, right, especially as you're working through your financial plan, there are 4 key takeaways that definitely affect the ability for your financial plan to be successful. Number 1, the long-term growth potential of real estate. As we discussed, real estate has historically appreciated over time, and this provides valuable options as it pertains to future liquidity, as well as asset generation for your next to kin, right? Being able to pass down assets of value to your family, through equity accumulation is a really, really great benefit. Number 2, consistent passive income, right? So you can definitely use real estate to act as a supplemental portion of your cash flow. If you begin to get multiple properties, it can eventually be your primary source of cash flow, right? So there are a lot of different avenues in which you can use the real estate income to supplement your financial plan. Number 3, effective portfolio diversification. And we can't preach this enough, right? Making sure that your portfolio is not fully 100% correlated to the next thing that's in your portfolio, right? We don't want your portfolio to feel like it's just 100% stocks and bonds. It needs to have diversification, right? It needs to have exposure to different elements that, again, will keep your overall portfolio neutral from a standpoint of avoiding risk. So, understanding the importance of portfolio diversification and how real estate can really achieve that for you. And finally, my favorite, guys, is tax benefits, right? We're going to beat this into you guys. There are so many amazing tax benefits that we can take advantage of within real estate that, again, can significantly add cash flow to your overall portfolio, and also put you in position to continue to diversify your holdings. So, yeah, these are all the great takeaways from real estate investing. And yeah, we're going to open the floor for a few questions before we head out.
Awesome.
I have a quick question, or I guess one of the things that I've been thinking about as it relates to real estate is barrier to entry. It seems like it's a very you need upfront capital, right? And I'm curious on like some of the strategies to kind of reduce the burden of capital, right, to get in?
Yeah, absolutely. So that's a wonderful question. And I think depending on the type of real estate investment that you're interested in, determines the complexity of that, right? So I will give you a real life example. I'm a part of a real estate syndicate here in New Orleans. We're working on a multi family project. Well, sorry, it's going to be a mixed use project that'll include multi-family housing, social components, food hall, things like that. And obviously, I would love to have the full capital to back this project myself. But that's not the case, right? So with this real estate syndicate, we're actually able to pitch to different investors that are looking for these type of projects, right? There is an appetite for everyone in real estate. What I've learned just in the past 3 or 4 years is that there are different appetites for different types of concepts, right? For a project that we're working on, which is considered commercial, this is more attractive to hedge funds, right? Hedge funds are looking to park a lot of money into long-term developments, right? Whereas if you're looking at a multi-family unit, maybe 1 or 2 units, that would be probably more of a local or regional investor ask, right? So depending on the particular concept, you will have to reach out into different types of networks. But I think the one thing that is pretty consistent with real estate is that there's always an investor market, right? And I think some of the barriers to entry, at least on the lower level, in terms of single family homes and multi-family homes, um, a lot of it has been streamlined to where you can actually qualify on your own, depending on your credit score, your liquidity. You may not need any additional investors, right? So I think it really depends on the type of concept. There are less barriers to entry on things such as residential properties. Typically on the commercial side, and advanced multifamily properties, you would need to potentially partner up with an investor that has maybe deeper pockets that is looking for this type of investment.
And I see we got Alan with a hand raised. Alan, would you like to add anything?
Yeah, just to kind of expand on what Jerel was saying, there are, a couple options for those that, don't have the capital or, don't want to put forth that much capital into real estate. So most people, when they hear investing, right, they think, okay, real estate, I got to put down 20%. But that's not always the case. If you look into purchasing a multi-unit, you can qualify for an FHA loan where you can be an owner-occupied tenant, pretty much, or owner-occupied landlord, and just only have to put down 3% of the value of the property. And that's not just specific to one state, that's across all 50 states. That's a federal program that you can qualify for that loan. And also, Jerel was touching on this a little bit too, but there are private lenders that you can find, that like to invest in real estate all the time. And so they may not require you to put down the full 20%, sometimes 5%, sometimes 10%. It just depends on what your portfolio is and what you're interested in, the risk involved in whatever property you're investing in, how much repairs need to be made, and all that stuff. So there's ways around it, and there's ways to get in, and I wouldn't let, certain, I guess, rumors or certain things, hinder you from it. You just got to seek it out. And, building connections and all that stuff definitely helps. But there are definitely options to getting into a house and buying real estate without putting down a bunch of money. So.
Very true. All right, we have one last question. So, around VA loans, are there options for VA loans or multiple VA loans or options for veterans? I assume this is around investment properties. So, yeah.
Yeah, so VA loans are definitely a really good resource to obtain funding. From what I know about VA loans, a lot of them are little to no down payment, right? So I think when we talk about barriers to entry, that tends to be a huge barrier, right? Is having the upfront capital to purchase a property. So I think with VA loans, a lot of times they also have lower interest rates than the typical loan as well. So um definitely if you are a veteran, you look into the VA route. I know Navy Federal is a really good um option as it pertains to VA loans, as well as some of the other banks and some of the government products out there as well. So yes, if you do have access to a VA loan, you can very well get an investment property such as a multifamily home for little to nothing down.
Yeah. And I know another one we didn't touch on a lot was NACA as well, right? Where they have the opportunity for 0% down. Now it's an um, incredibly lengthy process, but if it makes sense for you and if there's great opportunities, that's something worth exploring because it is 0% down, competitive interest rates. And especially if you're looking at multi-units, it can be a nice way where you're getting access with little to nothing down. And then you're doing that combination, exactly what Jerel talked about, maybe some long-term, maybe some short-term, maybe a combination of house hacking as well.
Yeah, yeah, absolutely. And like you said, NACA does have a pretty substantial set of rules and regulations. So it does take a little while to get through that process. But if you can get through that process, again, I mean, 0% down, no closing costs. You can really get into a multifamily property for little to nothing and then start your investment portfolio that way.
Awesome. Well, I want to say thank you to everyone for joining us. This was a super engaging session. We loved all the questions. Feel free to go to the link in our website, Zenith Wealth Partners, if you'd like to learn more about our services, how we help individuals just like yourselves on your financial journey. And stay tuned for our next webinar, which will be in September.